Hi, Asian guy here. I need you to check something right now. Pull out your phone, open your trading app. Look at the silver price. What does it say? If you're checking any Western exchange, COMEX, London Fix, Kitco, you're probably seeing a number around $71 per ounce. Maybe $72 if you caught it on a good tick. Now let me tell you what's actually happening on the other side of the planet while you're staring at that screen. In the physical silver shops of Tokyo, in the dealer offices of Osaka, in the vault facilities across Japan, actual bars of silver, the kind you can pick up and hold in your hand, are changing ownership for 20,000 yen. Do the math with me. At current exchange rates, that's roughly $130 per ounce. Read that again. $130. Now look back at your screen. $71? The difference is $59. That's not a spread. That's not a premium. That's an 83% gap between what the paper market says silver is worth and what human beings are actually paying for physical metal in the real world. I've been analyzing commodity markets for over a decade. I've seen dislocations before. I've seen premiums spike during supply crunches. I've seen temporary arbitrage opportunities open and close. But I have never, and I mean never, seen anything remotely close to an 83% divergence between spot price and street price on a globally traded commodity. When you see a 2% spread, that's normal dealer markup. When you see 5%, that's elevated demand. At 10%, you're looking at a genuine supply squeeze. But 83%? That's not a market anomaly. That's a market screaming that something fundamental has broken. This isn't theory. This isn't speculation. We have confirmed reports from multiple dealers in Japan. We have price quotes. We have transaction records. While COMEX is telling the world that silver is $71, Japanese citizens are walking into stores and walking out with metal at $130. And they're not complaining. They're not negotiating. They're buying everything available. Let me be very clear about what this means. The global pricing mechanism for silver, the system that's supposed to keep prices uniform across markets through arbitrage, has completely collapsed. The bridge between paper and physical has been burned. And the banks that are supposed to profit from closing these gaps are sitting paralyzed, unable to move. Why the arbitrage isn't closing? In a functioning market, this situation shouldn't exist for more than a few hours. Let me walk you through what's supposed to happen. Silver is trading at $71 in New York. Silver is selling for $130 in Tokyo. That's a $59 per ounce profit opportunity sitting wide open. A bank like JP Morgan or Goldman Sachs should see this immediately. They should be buying every single available ounce on COMEX at $71. They should be draining the New York vaults. They should be chartering cargo flights to Tokyo. Even after paying for insurance, shipping, refining into smaller bars, minting costs, and Japan's consumption tax, they'd still clear $30 to $40 per ounce in pure profit. On 1 million ounces, that's $30 to $40 million of essentially free money. Banks don't leave that on the table. They have entire departments dedicated to finding arbitrage opportunities a fraction of this size. A 5% arbitrage gets traders promoted. An 83% arbitrage should have every bank in the world scrambling. So why isn't it happening? Why has this gap been sitting open for weeks now? Why aren't the banks closing it? Because they can't. The infrastructure is broken. Let me explain the 3 reasons why this arbitrage is dead. First, the refining bottleneck. The silver sitting in COMEX vaults is in the form of 1,000-ounce industrial bars. These are massive bricks designed for wholesale trading between institutions. The Japanese retail market needs 1-ounce coins, 10-ounce bars, kilogram bars, products sized for individual investors. You can't just ship a 1,000-ounce bar to Tokyo and sell it to retail buyers. It needs to be melted down and recast. There are only a handful of refineries in the world certified to do this work, and they're already running at capacity serving existing orders. If a bank wanted to move 10 million ounces from COMEX to Japan, they'd need refining capacity that simply doesn't exist in the timeline needed to exploit this arbitrage. Second, the logistics freeze. Air freight capacity for precious metals is extremely limited. You can't just throw silver bars in a FedEx box. They require secure transport, insurance, armed guards, specialized handling. The number of cargo flights per month that can handle this volume is constrained. And right now, those flights are already booked serving existing supply chains. But the third reason, and this is the one that should terrify you, is the liquidity illusion. The COMEX inventory report shows approximately 270 million ounces of silver in the vaults. Sounds like plenty, right? Wrong. That 270 million is divided into 2 categories, registered and eligible. Only the registered category, currently sitting at 48.2 million ounces as of December 13th, 2025, is actually available for delivery. The eligible silver belongs to private investors who are simply storing their metal in COMEX vaults. The exchange can't touch it. The banks can't withdraw it. It's off limits. So the real available inventory isn't 270 million ounces, it's 48.2 million. And if a bank tried to withdraw, let's say 10 million ounces today to ship to Japan, they would trigger alarms across the entire system. Other market participants would see that withdrawal. They would realize the vaults are being drained, and they would rush to pull their metal before it's too late. The banks are trapped. They can see the arbitrage, they can calculate the profit, but they cannot execute the trade without potentially collapsing the entire paper market they depend on. So the gap sits there, open, bleeding, unfilled. This is what we call bifurcation. The world is split into two separate realities that no longer communicate with each other. In reality A, the paper world, silver is $71. It's abundant. You can trade it with a mouse click. Liquidity is infinite. The charts look technical. The price is consolidating. The analysts are drawing support lines and talking about resistance levels. Everything looks normal. In reality B, the physical world, silver is $130. It's vanishing. Dealers have 6-week wait times. Premiums are exploding. The people buying don't care what the chart says. They're not looking at Fibonacci retracements. They're looking at their collapsing currency and their collapsing confidence in the banking system, and they're converting cash into metal at any price. If you're a paper trader sitting in New York, staring at your screen showing $71, you're living in reality A. You're wondering why your silver position isn't making money despite all the bullish fundamentals you keep reading about. You're confused because the price isn't moving the way it should. If you're a physical holder in Tokyo clutching your bars, you're living in reality B. You're watching your asset trade at nearly double the official price. You're realizing that the metal in your hand is worth far more than the number on the screen. History tells us one thing with absolute certainty. Reality B always wins in the end. The paper market can suppress the price for months, even years, but it cannot suppress physical shortage forever. Eventually, the paper market runs out of metal to deliver against its contracts. And when that happens, the two prices don't meet in the middle. The paper price violently snaps upward to meet the physical price. We saw this in nickel in 2022. The London Metal Exchange had nickel trading at $30,000 per ton, while physical contracts were settling at $100,000. When the squeeze hit, they didn't average the prices. The paper price exploded to match physical reality. And in the chaos, the LME actually canceled trades. They rewound the clock and pretended certain transactions never happened to protect the banks from bankruptcy. We saw it in palladium in 2000 to 2001. Paper prices lagged physical by huge margins for months until the default risk became undeniable. Then paper prices doubled in a matter of weeks. New York will have to rise to meet Tokyo. Tokyo will not fall to meet New York. The laws of supply and demand cannot be suspended forever, no matter how much the banks wish they could. Now I know what you're thinking. You're thinking, Asian guy, if Japanese buyers are paying $130 and COMEX is at $71, the banks must be short at $71 and they're getting destroyed. They must be insolvent. This is it. The collapse is here. I need to kill that narrative right now because it's dangerous. It'll make you take reckless positions thinking the banks are going bankrupt tomorrow. They're not. Let me show you why. According to the latest CFTC Commitments of Traders report, the commercial traders, which is the polite name for JP Morgan, Citibank, and Bank of America, are holding a net short position of approximately 40,000 contracts. Each contract is 5,000 ounces. So that's 200 million ounces they're short. If silver moves from $71 to $100, that's a $29 loss per ounce. Multiply that by 200 million ounces, and you get $5.8 billion in mark-to-market losses. That sounds catastrophic. That sounds like bankruptcy. But here's the reality check. JP Morgan alone has Tier 1 capital reserves of roughly $300 billion. A $6 billion loss is 2% of their safety buffer. It's painful. It'll destroy their quarterly earnings. Shareholders will be furious. Bonuses will get cut. Traders will get fired. But it won't bankrupt the institution. It's like getting a flat tire on your car. Annoying? Yes. Expensive? Yes. Does it mean you abandon the car on the highway? No. You have a spare. You have insurance. You fix it and drive on. The banks have the ultimate spare tire. It's called the Federal Reserve. If things got truly desperate, if the losses approached $50 billion or $100 billion, the Fed would open the discount window. They'd provide liquidity. They've done it before in 2008. They'll do it again. But there's another reason the banks aren't panicking yet. Most of their short position isn't naked speculation. It's hedging. Here's how it works. A silver miner in Peru digs up 10 million ounces. They want to lock in a price so they can pay their workers and plan their budget. They call JP Morgan and say, "We'll sell you 10 million ounces at $70. JP Morgan agrees. Now JP Morgan is long 10 million ounces of physical silver, or a forward contract for it. But they don't want price risk. They just want the fee. So they immediately go to COMEX and short 10 million ounces. Now they're neutral. If the price goes up, they lose on the COMEX short, but gain on the miners contract. If the price goes down, the opposite happens. Either way, they collect their spread and avoid directional exposure. So when you see that 200 million ounce short position, a huge chunk of it is probably hedged against physical purchases or forward contracts with miners. When silver rips to $100, they lose $6 billion on the shorts, but gain $6 billion on their long physical positions. Net effect, roughly zero or close to it. I'm not saying they're perfectly hedged. They definitely have some naked short exposure, probably 30 to 50 million ounces, where they're genuinely betting on lower prices. And that portion is bleeding. That's why we're seeing stress in the repo markets. That's why lease rates spiked from 2% to 8%. They need cash now to meet margin calls while they wait for their long positions to pay out. This is a liquidity crisis, not a solvency crisis. There's a massive difference. Liquidity crisis means you're rich on paper, but don't have cash in your pocket right now. Solvency crisis means you're actually broke. The banks are facing the first, not the second. And if you think the banks will just roll over and die, you're underestimating their final weapon, the rulebook. If silver went to $200 overnight and the banks faced $60 billion losses, do you really think COMEX would just let them fail? Do you think the government would allow the financial system to implode over a shiny metal? No. They'd change the rules. We've seen it before. In 1980, when the Hunt brothers cornered silver, COMEX implemented liquidation-only rules. You could sell, but you couldn't buy. They broke the squeeze to save the banks. In 2022, when nickel exploded on the LME, they canceled trades. They literally rewound the clock. If silver threatens the banks, COMEX will declare force majeure. They'll halt trading. They'll implement emergency cash settlement at a fixed price. They'll say, everyone settles at $75 and market closed. Your paper contracts become worthless. Your futures get converted to dollars at the price they choose. This is why I keep telling you, don't play their game. If you hold paper silver betting on a bank collapse, they can change the rules of that paper. If you hold physical metal, they cannot change the laws of physics. They cannot cancel the bar sitting in your safe. So erase the fantasy that the banks will collapse tomorrow. They won't. They'll limp away wounded, but they'll survive. However, and this is critical, their survival mechanism is exactly what allows silver to rise. Because the cost of continuing to manipulate has exceeded the benefit. The banks can handle a price squeeze on paper. They have capital. They have the Fed. They have the rulebook. But there's one thing they absolutely cannot handle, a physical supply shock. And that's exactly what just hit. On December 1st, 2025, China's Ministry of Commerce Notice Number 47 went into full effect. Most analysts focused on the gallium and germanium controls. What they missed was Appendix C, the list of 14 polymetallic refineries that produce 62% of China's byproduct silver, now requiring export licenses. That's 3,400 metric tons per year, 13% of global silver production, suddenly under bureaucratic control. The licensing process takes 45 to 60 days minimum. Even if approved, that's a 2-month delay on every shipment. For manufacturers relying on 30-day delivery cycles, this is catastrophic. Between August and November 2025, Shanghai silver inventories dropped by 660 metric tons. That metal didn't disappear. It was moved from a transparent exchange warehouses into state reserves where Western tracking systems can't see it. China is clearing the visible supply before the controls bite. The Shanghai silver inventory dump between August and November makes perfect sense now. While Beijing maintains the appearance of cooperation, they're fundamentally restructuring supply chains beneath the surface. This is the classic Chinese strategy: appear reasonable while quietly securing strategic resources. And here's why this creates a permanent deficit for the West. The US doesn't mine enough silver to meet its own demand, neither does Europe. We rely on imports from Mexico, Peru, and China. Take China out of that equation, and the entire system tilts into shortage. The Silver Institute's 2025 report shows industrial consumption hit 1.21 billion ounces, while mine production delivered only 830 million ounces. That's a 380 million ounce deficit. Solar panels consumed 264 million ounces, up 18% year over year. Electric vehicles added 110 million ounces. The demand is structural and growing. If China's export controls reduce available supply by even 20%, that deficit explodes to 680 million ounces over 2 years. There's no mathematical way to fill that gap without prices rising high enough to either destroy demand or incentivize massive new production. Neither happens quickly. Industrial buyers can't redesign products overnight. A solar panel manufacturer can't switch to copper contacts and maintain the same warranty. An EV maker can't use aluminum in charging systems and meet safety standards. They'll pay higher prices before they retool. This is why the Japan premium exists. It's not just speculation, it's industrial panic. It's companies realizing the supply they took for granted is vanishing, and they're bidding any price to secure inventory before it's too late. And this is why JP Morgan's reported accumulation of 750 million ounces makes perfect sense. According to the December 11th Economic Times report and November 13th F filings, JP Morgan flipped from 200 million ounces short to long physical positions between June and October 2025. They saw China's regulatory changes coming before anyone else and repositioned accordingly. Their Q3 2025 earnings showed a $6.2 billion increase in other assets with minimal explanation. At average, Q3 prices of $30 to $35 per ounce, that's approximately 177 to 206 million ounces of silver purchased. The timing aligns perfectly with China's export control implementation timeline. This wasn't a leak, it was a signal. When you reveal your position after building it, you're ready for price discovery. You want shorts to panic, you want the rally you positioned for. While all this is happening, the COMEX inventory is draining like a bathtub with the plug pulled. Registered silver, the only metal available for delivery, stood at 78 million ounces in January 2025. By June, it was 64 million. As of December 13th, 2025, it's down to 48.2 million ounces. That's a 38% decline in 11 months, and the drain is accelerating. Global silver consumption averages 3 million ounces per day. COMEX is sitting on 16 days of world supply. But here's the terrifying math. Open interest represents 815 million ounces of paper claims. That's 163,000 contracts times 5,000 ounces each. Normally, only 5 to 8% of contract holders demand physical delivery. Most roll their positions forward or settle in cash. But 5% of 815 million ounces is 40.75 million ounces. If even a normal percentage of longs decide to stand for delivery, COMEX doesn't have enough metal. Now, we're not in normal conditions anymore. When longs see the Japan premium at $130, when they see China locking down exports, when they see JP Morgan accumulating, they're going to stand for delivery in much higher percentages than historical norms. February 27th, 2026 is first notice day for March contracts. There are currently 73,000 open contracts for March delivery, 365 million ounces of claims against 48.2 million ounces of available metal. If 15% stand for delivery instead of the usual 8%, that's 54.75 million ounces demanded against 48.2 million available. Mathematical impossibility. COMEX cannot physically deliver. At that point, they have three options. Force cash settlement, which triggers lawsuits and destroys confidence. Implement emergency liquidation-only rules, which causes paper silver to crash while physical premiums explode. Or source emergency supply from ETFs. But JP Morgan controls SLV, and their 8% lease rates prove they're not lending. All roads lead to the same place. Paper and physical prices decouple completely. The 815 million ounces of paper claims become worthless IOUs. Physical metal trades at true scarcity pricing based on what desperate buyers will actually pay. This is Gresham's law in action. Bad money drives out good. Artificially low prices drain physical supply. Every time the banks smash paper silver to $68 to defend their positions, they ring the dinner bell for smart money to stand for delivery and loot the vaults at discount prices. The banks are victims of their own manipulation. They suppressed prices so effectively that they turned silver into the most undervalued asset on the planet. And now the world is backing up trucks to take it away from them at the artificially low price they created. So here's your choice. You can hold paper silver, SLV shares, COMEX futures, allocated accounts at banks, and hope that when the music stops, your custodian honors their commitment to deliver physical metal. Or you can read the fine print. SLV's prospectus explicitly allows cash settlement during extraordinary market conditions. Your allocated account agreement has force majeure clauses. When physical silver is trading at $150 and paper is at $75, they will offer you cash at the paper price. You'll have paper profits in dollars while the real asset escapes to prices your dollars can't reach. The people paying $130 in Tokyo right now aren't doing it because they're stupid. They're doing it because they understand that when the system breaks, the paper price becomes irrelevant. They'd rather own metal at $130 than hold claims at $71 that might settle in worthless cash. Don't chase the Tokyo premium. That's panic pricing. But don't trust the COMEX price either. That's a lie. So the opportunity is exploiting the gap while it exists. Here's your battle plan. Buy physical silver at current prices. Yes, you'll pay $5 to $8 premiums over spot. But $71 plus $8 is $79. You're getting the same metal that Tokyo pays $130 for at a $51 discount. You're arbitraging the bank's fraud. Every ounce you buy at $79 is theft from a system trying to deceive you. Ignore the volatility. Banks will smash paper prices to $65 to shake you out. Don't look at spot price as wealth measurement. Look at ounces owned. When they crash the price, buy more. Use their manipulation to lower your cost basis. Watch the registered inventory. When it drops below 30 million ounces, you're in the endgame. That's your signal to stop buying and hold tight. Don't use leverage. Don't trade futures. Buy physical and hold it in your possession where counterparty risk cannot touch you. The banks will survive. They have capital, but they've lost control of direction. The China supply shock, the Japan premium, the inventory drain. These forces are bigger than their balance sheets. The price must rise until it either destroys industrial demand or incentivizes massive new supply. Neither happens at $71. We're heading to 100 plus in 2026. The structural deficit, roughly 200 million ounces annually after China's controls, cannot be filled by flat mine production. The math is simple. The destination is locked. But it won't be a straight line, it'll be a grind. Banks will engineer volatility to make you doubt. They'll spike premiums, crash spot prices, raise margin requirements, and make holding silver feel like torture instead of triumph. They want you to sell and chase Bitcoin or tech stocks. Don't. Because when the dust settles, when registered inventory hits zero, when COMEX declares force majeure and paper markets freeze, the only thing that will matter is whether you're holding physical metal or digital promises. Reality B always wins. The physical always defeats the paper. Tokyo's $130 is telling you the truth. COMEX's $71 is telling you a lie. The question is which one you believe.